All right, so let's see. What are you seeing?
I'm seeing all of it. I mean, like top half.
Okay, I'll fix it. I gotta sign in. Better?
Yeah, perfect. Do you want me to leave this open or closed?
It doesn't matter. Everyone's
Okay.
basically done for the day.
Okay. All right. Check the microphone. Check, check, check.
Check, check, check. Oh, I don't want to start.
And you're live.
Live?
Mm-hmm.
Good.
I feel like we need to add some music.
Do we need to add some music?
Is
there a live over there? It's live over here.
Yeah.
Let me see. Where's a Wi-Fi on? All right. Let me see. Delete. Okay. Settings. My Spectrum 2G. No, man. Get on not yours. It was on 2G. What is going on here?
Oh, Ronald is back on YouTube. Say hi to Ronald.
Hey, Ronald, what's up? Hey, guys. What is going on with IG? It's spazzing out. All right. Doing a book giveaway, guys. Signed copy by Robert Kiyosaki. Rich Dad, Poor Dad. So I actually have a copy, one for you, and I got another signed copy of Rich Dad, Poor Dad. One for your friend. So pretty cool if you guys are watching my lives and watching my posts. When I was in Belize, I was hanging out with Robert Kiyosaki. We had a bunch of lunches with the private group. George Gamma was there. Dr. Doug Duncan's there. It was a great time. Ken McElroy was there. Lots of great people big in the real estate game. So lots to learn. Learned a lot about gold. Some big gold investors were there as well. So it was a good time. And when I was there, I got a whole bunch of books signed by Robert Kiyosaki. And I'm going to actually be giving these away. One would go to you and one to your friend. So we'll talk about that a little bit later. All right. So how's everybody's week been? Awesome. So as you guys have been as you guys know, I've closed on 2 properties in St. Petersburg, right in downtown St. Pete. A 4-unit and a 7-unit. We're going to be making it the whole same setup as the cottages. Another cottage community. We got a 3rd cottage community, and I'm working on another house on Beach Drive, which is also in downtown St. Pete, that we're going to be added to the cottage community complex. So a lot of good stuff coming. Super excited. Should be a good time. Hey, what's up, everybody? All right. Any properties available in Kissimmee? Right now, I'm not really looking in that area. I'm not interested too much in that area, but it is a good area to invest in. Thank you, Mastro. Hey, Sharon, what's up? So, guys, as always, those who ask to go live on Instagram, I get to answer their questions first. Those that are put the question in the question section on YouTube and IG, I answer those questions second. And lastly, the questions that scroll to the DM, answer third. Yes, of course, Faye, you may be able to ask a question. Just make sure to put it in the question section. So, for all those that don't know, Baskal Korkis, I teach real estate, finance, investing, taxes, insurance, mortgage. Any question you have regarding those topics, I'm happy to answer, happy to help. I started with nothing, came here, wasn't born in this country, and fell in love with real estate at 14. And by 19, I started buying real estate, bought my first duplex, and by 23, I had 23 units. So I'm happy to help and answer your questions. Yeah, sure, Faye. Just request to go live. Master says, are you familiar with a 1033 exchange? Not the 1031 exchange. Thoughts? I believe the 1033 exchange is kind of like a reverse exchange. I believe that's what it is. I believe it's the reverse exchange. So it's basically an after the fact exchange. You can state up front that you're going to buy a property first and then sell your property so you can roll your tax savings into it. That's a good question on 1031 exchange taxes. Yes. Hey, how are you?
Hi, Baskal. How are you?
Good, thank you. Good to see you again.
Good to see you. So nice I caught you live again. So, my question is, what I'm going to be doing in a couple of months is I'm going to refinance my house. If you remember that I told you,
You had that tax situation with your daughters. You transferred the property out of your name into your daughter's name. Did not know you would lose your homestead exemption, and then you were going to transfer it back, and you didn't know that you had a tax consequence at the same time when you did all of that. I have a good memory for finance.
Yeah, a great memory. So if you remember that part where I told you, my daughter put it in the LLC.
Yes.
So now that I want to refinance in a couple of months, I can just bring back the house back in my name.
So this is the situation that you're going to be coming into because the properties are in your daughter's names, right?
Yeah. So it's LLC, but it's in both of my daughter's name.
Correct. So the issue that you're going to run into in your refinance process is that they're going to have to give it a sales price, and you're refinancing it into your name. So for them, the issue you're going to come up with, and I don't have a direct answer with this because it's a very unique scenario. When you say you owned an LLC and the LLC was in your name, when you transfer it back into your individual name out of the LLC, the bank looks at it as the same ownership, and there is no seasoning process because they know that you own the LLC and it's transferring it back into your name. So it's to the bank, the same person consistently owns it, nothing changed. When it's an LLC that is not owned by you and you transfer it into your name, it's looked at like a sale. How is the bank going to interpret that? I do not have a direct answer. You'll actually have to talk to your broker and see how are they going to assess this? How are they going to assess the situation? And depending on that answer will determine how much money you could get out in your cash out refi.
Oh, so I'm not looking to get money out of my house when I refinance. I'm only refinancing to bring down my interest rate. That's the only reason why. Plus, I want to bring the house back into my name. But the LLC is in both of my daughters' names. But one of them, her name is already on the loan of the house.
Mm-hmm. Mm-hmm.
One of them.
Yes.
So I don't mind. I just want it back in my name. I don't want it in the LLC. My name in it, and
Yes.
her name is fine.
Yes. And it's better that if her name is not on the loan, that's my advice, is if you can avoid that, it's better. But if you have to, then you have to. The other thing
That's a plan.
Yeah, and the other thing I would do is try to get a 30-year mortgage to get the lowest payment possible. And honestly, you should take out as much equity as possible, because this is the lowest, cheapest money you're ever going to get. And it's better to have the cash in your pocket than the equity in your home, in my opinion. If equity disappears, if the market tanks and equity disappears, the money vanishes, the value in your home vanishes. So it's better that you take it out, put it into your checking account, have the money there, and if it vanishes, it doesn't matter, because the cash is still in your account and you could do with it as you see fit. It is a great opportunity to borrow money at 3%, and then there's multiple real estate investment groups that offer 15% IRR or greater. So you're going to get 5 times on your money. And what that means is now your money is working for you. You're not working for your money. So,
Okay, so you recommend that when I refinance, not only refinance for the sake of bringing down the interest rate, but also take the equity out.
Yes. Because, like, for example, what is your current interest rate?
3.8%, 3.875.
Yeah, 3.875. Yeah. Now, what do you currently owe?
I owe about 280,000, but the house is worth right now close to 750, something like that. Maybe even 800.
Okay, so $300,000 is roughly $1,200 a month for principal and interest, not counting taxes and insurance on a 30-year mortgage. If you got out $500,000, it would be $2,000 a month plus taxes and insurance. So as you can see, it's $800 more a month, but you have $200,000 more in your bank account. You can put that money and reinvest that money somewhere else, and you can end up an internal rate of return probably at least 15%. So that's a very good amount of money you can make on your money, that now your money's working for you instead of you working for your money. Whenever someone says, like, the reason David Ramsey doesn't like loans and says pay down your loans is because he was a real estate investor and he made a mistake and he lost everything. His issue was he took short-term loans on a long-term investment. And that's 101 of real estate. You never take a short-term loan for a long-term investment. It's like taking a credit card to buy a house. It doesn't make sense. Taking out a credit card to use it as a down payment on a house, not a smart idea. But what I'm saying is take a long-term loan to make an investment. A 30-year mortgage with a fixed low payment, that is a great amount of money you could leverage to do more with. And $800 a month, is probably, if you took out $500,000, $550,000, it might be very close to what your current payment is. So you're already comfortable with that payment. So that's one good part of it. And now you just have a whole bunch of extra cash. You can invest in something, have that money grow, bring in more passive income, because that's the fastest way to retire. My one friend was trying to pay off his house. And I said to him, okay, you pay off your house. At the end of the day, you're still going to have to work for the rest of your life, because paying off your house doesn't free up your cash flow.
Yeah.
You pay off a $550,000 mortgage. All you saved was $2,000 a month. an extra $2,000 a month will not help you retire quicker.
Right.
Having
Yeah,
more-
that makes sense. So for me, I'm going to bring down, do the refinance, bringing down the interest rate, and then bring the house back into my name. And you said they're going to consider it as a sale where they're going to reassess the house.
They might. I can't give you a direct. So what I would have to. So if I was doing your mortgage, I would have to call the bank, and I have multiple lenders. I work with more than one bank. So I'd call each bank and say, how are you going to assess this? How are you going to look at it? And is there a seasoning aspect to it? So depending on their answer will give me an idea of how they're going to assess the property, how are they going to season it, and the different factors. So it's not a big deal. It's just people have to do footwork ahead of time to make sure things are done and accomplished properly. I have a doctor here, and they're buying a house, and they're asking me, well, what can I do to make sure I'm getting approved? Because they're buying this house that they really wanted to buy, and they've saved money their whole life, and finally they get to buy this $1.3 million house on the water, and they really want to get it, and they don't want anything to get screwed up. So they're like, what do I need to do to make sure to accomplish the goal? And they're not planning to sell their existing home to buy this other house. I said, well, you want to make sure that you have a lease up front that someone's going to rent your house when you move into the new house. Because based off of your income, your gap is very close to afford a $1.3 million home. But if you have a lease, and that lease shows you're going to bring in more money into your existing home when you move into the next home, that's going to make the bank feel a lot more comfortable. They're going to use that income towards your income, and it's going to make it easier for you to qualify for the loan. So there's a lot of tricks that can be used to make sure that the loan goes through and you accomplish your goal. And the better you do in the beginning, the more you, invest in a front end, and you do things properly, you're going to be able to accomplish your goal.
Okay. And then also, you highly recommend I take out the equity.
Yes. My mother.
All of it?
My mother's 65 years old. She's worked in the hospital her whole life, I'm from Syria, so my mom's from Syria. She was a midwife in Syria, delivered babies in the desert, and whole life and working in the hospital. Now she was in the hospital, and she had a 401k with the hospital, and she's like, I'm making no money. And my father was investing in real estate, and she didn't know she could put her money out and use the money in her 401k for real estate. So finally, she's like, I'm making nothing on all this money. So she's pulling it all out. She's just giving it to me. And she's like, here you go. Go invest it. Buy more properties with it. Manage it. All that stuff. She's doing a home equity line of credit on her house. She lives next door to me. Pulling all the cash out. Investing it in the multi-units that we buy. Half of them are annual rentals. Half of them are Airbnb. I'm doing the same thing. I'm doing another refinance on my house. Doing one mortgage. I'm keeping the loan under jumbo levels. So my home is about as much as the home I own is about as much as your home. And I'm keeping the loan about 550 because at 550 is the jumbo level. Above 550, fees go up a lot, rates go up, all those costs go up. So I'm keeping it under 550 to be under jumbo. And then the rest of it, I'm going to get a home equity line of credit to pull the rest of the cash out. So when I'm done, me personally, I'll have zero equity in my home. Because I'm pretty comfortable with this strategy. So the comfort with this is that the home value of $750,000 with equity or without equity in it will still go up, will still grow, will still appreciate. So me having equity in a home has nothing to do with the home value going up. What it has to do is when I take the cash out, am I doing something smart with it? Am I investing in something that's going to build me more cash flow?
Right.
And as long as I keep on investing in things that give me more than 3%, which is very easy for me. Again, like, all my clients make over 15%. My last client got a 19% dividend on her last payout on the Safety Harbor cottages. I mean, thank God, it worked out amazing. So there's a lot of ways and a lot of good people you can invest with that can accomplish that goal if you don't have anything in mind you personally want to do. But the point is, there's a lot of things you can do, and with hyperinflation coming, it's returning higher than 3% is going to be easy, in my opinion.
What do you mean by hyperinflation?
So, okay, let me see. Okay, back in 1964, there was 2 quarters. Back in 1964, that quarter could buy you a gallon of gas. In 1965, there's 2 different types of quarters. Both quarters could buy you a gallon of gas in 1965. Today, the quarter from 1964 can still buy you a gallon of gas. The quarter from 1965 cannot. The quarter from 1965 has no silver in it. It's only worth a quarter. But the quarter from 1964 has 90% silver in it. It's worth $5 worth of silver. If you exchange the quarter, you can still buy a gallon of gas. And that speaks on a topic of there's a difference between currency, which is the stuff that's in your pockets, the stuff that's in your bank account, and money. Money, gold, silver, oil, bullets, real estate, that's money. It can be exchanged, has intrinsic value, can go up in value as times change. If you peg your home price, the value of your house, to ounces of gold and silver, it would cost you roughly the same amount of ounces of gold and silver back in 1980 as it would today to buy your house. The trend line is roughly flat. But if you peg it to dollars, which is not really money, it's not money, it's currency. The dollar keeps falling because of inflation. Well, when you have hyperinflation, crazy money printing, we in 2020 we had 25% of the money supply increase, and then 2021 we had about another 25% we're going to have increase. So we had just doubled our money supply. And if you know how it works in the Middle East and the Spanish countries, when you hyperinflate the currency, the purchasing power of that money is worth less. Because again, it's a currency, it's not money. We're not pegged to silver, we're not pegged to gold, we're not pegged to anything. The only thing our money is pegged to is humans in America. So when people ask about how come people don't go to jail for not paying their debts anymore, it's because our currency itself is a debt. The money in your bank account is a loan to the government. And when you have a loan, there's always interest. Now the question then comes to if the cash in your checking account, that cash is a debt. What is your interest that you pay? You're
asking me?
Yeah, the interest that you pay. What is it?
Interest that I pay in my checking account?
Yeah, you pay interest to the government because it's a loan. That cash is not real. That cash is a debt. American dollars are notes. These notes are debts. So what is the interest you pay?
I don't remember.
It's called inflation.
That I don't remember.
It's called inflation.
Inflation.
So when they say there's a 2% or 3% inflation, the inflation actually means interest. You are paying the government interest for the dollars in your bank account. So they're taking payment from you. And how they do it, instead of taking it from you in your tax return or taking it from you physically, all they have to do is make the money in your bank account worth less.
Wow.
And that's why. So when they say, oh, the price of chocolate went up so much, it used to be a nickel when I was a kid. It was like, oh, it's a nickel and now it's 50 cents. Well, now that same chocolate bar that was 50 cents is worth like $1.69. It's not that the chocolate went up by you. Cocoa is a currency. People will trade cocoa for something else. So it's not that
Right.
cocoa got more expensive. It's that the dollars you're giving them are worth less. So you're required to give more in exchange.
Got it. That makes perfect sense. Wow, I've never thought of it that way.
So last thing, this is a really cool thing, right? Someone explained it this way, and it's the best explanation I've heard so far. You and all your friends are going skydiving. You're all going skydiving. You're in the plane, 30, 45, 50,000 square feet, right? It's pretty high, right? But anyway, so you're jumping out the plane. The dollar jumps out, the euro jumps out, the yen jumps out, the yuan jumps out. All of them are jumping out of the plane. They're diving down together. And then first one, the dollar pulls the parachute. And it's woof, goes up. Now, compared to the yen, the yuan, the euro, the dollar looks like it's going up. But compared to everyone on Earth, the dollar's still falling, just slower.
Wow.
So when you're looking at, when you start brainwashing yourself to say dollar denominated everything, you have a flat line of the dollar. You don't see the dollar's purchasing power falling because everything in your mind is on this ground level looking at stuff. But if you are denominating everything in gold, silver, or something else, you'll start, or other currencies, you're going to start seeing, no, it's not that the dollar has gotten, it's not that everything got more expensive, it's that the dollar itself is cheaper.
Yeah, wow. Well, great analogy. Explanation, actually, yeah.
So the question is, everyone has a why, and Master wants to know, what is your why? What is the thing that you're going for? What is that thing that drives you to say, I want to have financial freedom and I want to do this thing? I'm studying finance for a specific reason. So what's your why?
My why is definitely, I want to have cash flow from investments. I also have another investment with my daughters, and they're duplexes too.
Awesome.
And that's the why, because I want to eventually have my future income from properties, so I don't have to work. And as you know, investments in properties are the best way and to retire. That's like my why, and not have to work so hard.
So your why is so you can retire.
So I can retire, exactly.
Yes.
Yeah. So I can retire and have, and of course, with properties, they grow in value. I mean, they definitely have here in San Diego very, very much. And it's great. I mean, investments, especially in California, is really great. I mean, I don't know what you know about California, but yeah.
Yeah,
although it's crazy now.
I don't touch anything in California for two reasons. One, the laws are built against landlords. So I don't invest in states that are not landlord friendly. Two, the properties in California normally do not cash flow well. Like you don't bring in a lot of money for the amount of money you spend. Like it's very,
that's true.
It's very low. So I invest normally in Florida, right, in the Tampa market, because there's this what's called the silver tsunami. For the next 15 years, all the baby boomers are retiring, and they're moving to Florida, Texas, and Arizona. So we're going to have a significant increase in property values. In addition to that, we can actually profit off of rent here. Like there is positive cash flow from renting properties, where a lot of properties in California, if you put down 20%, 25%, you're not really making much money off of the rents. It's very, very hard to accomplish that.
So would it be easy for me if I were to take the equity from my house and invested in a property in Florida, although I don't live there?
Yeah, you could do that. It's possible. They're saying, is she Kathy Woods? So do you know who Kathy Woods is?
No, who's the
So
actor?
no,
Actor?
Kathy Woods is this like amazing woman that's an investor, and she has a very awesome insight on how her viewpoint of investing is great, and she manages a very very large investment fund, like hundreds of billions of dollars. So you know, it's
Like Barbara Cochran.
yeah. So you do look like a little bit like Kathy Woods, but yeah, it's funny. It's funny.
Thank you. I wish I was.
Yeah, you're like I could use her money too.
I know. Yeah. So if I were, and you said I can invest in Florida, I know Florida is so much cheaper and easier to work with.
Yeah, I mean, it is a really good area to invest in. Normally, you just get a property manager, but it's really hard to find good. It's really hard to find to get a deal in Florida because they go fast. Like when I buy property, I know about it before it even hits the market. They'll call me and be like, I got this deal. You want it? And I'm like, yeah, I'll take it. So every property I bought it basically before it hits the market or within the first 10 minutes of hitting the market. So that's why when you like look at my performance and see the returns we're making, we double and triple what the average is because we buy all the good deals right away, you know? But yes, you just get a property manager and they would manage it, you know?
Maybe I can have you find me something.
We could figure something out. I just actually did, we just did a raise right now. I have an investment group. So there's a whole bunch of people across the country that most of them are actually my tax clients. And because they need big tax write-offs. Because when we buy properties, I do cost segregation models and they get an ownership of the package of properties we buy and they get a K1 for the tax write-off. And that tax write-off reduces their income tax. So they save a lot of money on taxes and they get the profit of the property. We manage the property and we do half Airbnb, half annual rentals. So we just raised $1.5 million. We just bought 2 properties right next to each other in downtown St. Pete, 1 block from the water. And we have another property under contract. If you saw the video today on my story, Beach Drive, we have that one under contract. We got under contract for $925. And my realtor actually lives right next door to the house. So I joke with him. I was like, yeah, you're going to watch it for me. And so, like, you know, for example, if you saw that location and that view, that property, 3,000 square feet triplex in LA, in California,
Wow.
What is it worth?
Oh my God. And right on the water?
Yes, like right across, right in water view, yeah.
Who knows? 5-6 million.
I bought it for $925,000.
Easy. I'm going low.
Yeah.
Easy, 5-6 million on the water. I saw.
So we're gonna spend $500,000 on that property, making it nice, super nice, and we're gonna do Airbnb at that location. I said easy in 10 years. I'm not gonna say tomorrow. I'm not gonna say next year. I'm gonna say it's gonna block someone. In 10 years, it's worth $5 million. And what's our down payment on that property? Our down payment on that property is like $370,000, $400,000. That's our down payment. Well, we're going to make $4 million of appreciation over 10 years. So we're going to make 10 times the money just in appreciation. Ignore the rent, ignore everything. And our Airbnb rent is crazy because we'll do half Airbnb, half annual. So we're making great, we're going to make amazing money on it. Our returns, like I don't promise this, but our pro forma shows 700% return on the other property down the street. This one's obviously on the water. It's going to be even better. It's going to probably be around like 1,400%, which is unheard of. 1,400% over 10 years. And I don't advertise that. That's not advertised. No. You know, I say if you make 15%, that's awesome. But we've always done ridiculously better than that. But anyway, that's the benefit of buying properties in Florida. If you have a 10-year outlook, you're going to be, you know, it's going to do well. You know, it's going to do well as long as you have a long-term outlook.
I have a friend. I think she's buying or she bought a house in Florida, but she doesn't live in Florida. She lives in Nebraska.
Mhm.
So now me having this conversation with you, I'm thinking when I refi my house and I have that equity in it, maybe that would be a good idea to invest in Florida.
It is a good idea to definitely look into it. And I wanted you to make sure that you're very careful, because just in anywhere you buy, where you buy, the street you buy, all those factors matter. Because the properties that I'm buying, the location I'm buying, I'm 1 block from the water, so it's really good. But if you bought 5 blocks out, you'd be like, well, Baskal just paid, $900,000 for a fourplex. That's not on the water. I'm gonna go pay $900,000. I'm gonna get an 8 unit, and that's gonna be just as good. The issue is there is 8 units for 900 grand, but it's not the area you'd want to have your money in, because it's not going to get the rents you want. There's going to be headaches, and it's not going to have that appreciation. So I'd rather remember location, location, location. You're going to make your money. When the economy went down in 2008, the good locations kept paying the rent. The bad locations weren't.
Right.
So if you have a good location, even if the market goes down and your property loses value on paper, you're still going to collect your rent.
Right. So location is important. For when I get the equity from my house, you said they charge under 500. They charge, is it 3%? You were
Say it
mentioning
again.
that earlier. So the equity on the house, I think you were mentioning anything under 500, they charge. Is it 3%?
So it depends. It depends. It was.
I mean, I've never done that before. They do charge interest, right? When you're taking equity out?
Oh, yeah, it's just like any mortgage. When you refinance, it's an interest. When you take equity out, it's interest. It's the same interest. Right. So it depends on your credit score. It depends on many factors, right? So when you look into all those factors, right now the rates are between like 2.5 to 3.25, depending on your down payment and depending on your value, how much equity you have in your home, and all these factors for primary residence. Now, when you talk about investment properties, rates are even higher for an investment property. You're going to pay a little bit more for that. But still, it's cheap in my opinion, because when I was buying loans, buying properties, I was getting loans between 6 and 8%.
Wow.
So, but I was still making money. So don't ever get confused like, oh, I'm paying this much interest, and we used to be able to get loans for 2.5, and now it's 4% for a loan. It's too much money. Most of the loans I'm getting right now are 4.5% interest because they're commercial loans. But it doesn't matter. I'm still making money. It doesn't matter if someone's going to charge you this. A lot of people that I've known in my community, they're like, oh, I don't want to do this because I have to pay this guy this thing. And I'm like, what do you care what you pay him? You should be happy paying him. You should pay him a lot of money, because if every time you pay him, he's making you double the money, then keep paying him.
Right.
Make the money. So it was great talking to you, and go do some research and come back next week and ask more questions.
Perfect. Are you here every Wednesday? Is that what it is?
Usually every Wednesday at 9 p.m. I go live.
Oh, every Wednesday, 9 p.m. your time. Yes. Okay.
Yeah. So normally I tell people, take my course. Once you take my course, there's going to be a lot of questions that is going to actually give you more questions, because you're going to learn what you did not know. Like there's a whole bunch of things that you didn't know. So when you take the course, you learn those things, you come back, and then you join the live and you ask your questions to say, okay, you said this in the course. How do I apply this? How does this affect me? And then I go and I deep dive in that.
I see. Okay, perfect. That's great. Thank you so much. I really appreciate your time. You did a great explanation for me.
Thank you. Have a great day.
You too. Thank you.
Yes, Hannah.
I have a question from Ronald. He's saying, I'm currently structuring my finances so that I'm able to qualify for an investment property. Okay. Is it legal for me to pay the co-borrower through a lease? Can this increase her income? will I be able to refinance out of the loan in the future?
I mean, well, it's legal to pay a co-borrower through a lease if you're leasing it. Would that increase her income? Yes, it would increase her income, but it could be offset by expenses and depreciation. It really depends on all the details.
He's saying here, I'm in the middle of refinancing my primary residence. I wasn't able to refinance myself out of the loan because my co-borrower couldn't afford the mortgage on her own.
Interesting. I mean, that's fine. I mean, I don't really understand what the issue is, because if you co-own a property, it's not an issue, right? You guys both own it, and if you're both paying rent or you're both sharing the expenses in the property, that's also not an issue. So I don't understand where the problem lies.
Ronald, get on Instagram Live.
Yeah, I don't see where the problem is. Because if you're both owning the property and you're both on the loan and you're both using the property, then I don't really see where the issue is. Again, it's preferable that you have the loan, one of you have the loan by yourselves, so that way you can get 10 loans in your own name and she can get 10 loans in her name. But if you can't, it's better for you to do it than not do it at all. It's better to get a deal done than not do a deal. The best time to buy real estate is 10 years ago. The next good time to buy a good deal is today. So I'm still buying properties. I'm just making sure that I'm getting quality properties.
That answers actually, Peter Williams had that question. He loves the content. Thanks for the great advice. Is now a good time to buy, or should I wait until mid next year in 2022?
I don't see the market coming down until 2023, maybe 2024, because all the forbearances and foreclosures, they're not going to really be able to hit the market. It's going to take 2 to 3 years for those things to actually roll out and hit the street. And by that time, there is just such a backlog of people wanting homes. In addition to that, we have there's still 4 years left before we hit the peak buying from millennials. Average age of millennial right now is 33. The millennial Hannah's 33.
Yes.
Happy birthday. But the peak age for home buying is 37. So there's a significant amount of people that in the millennial market that's going to start buying homes over the next 4 years, and it's going to gradually grow. It's going to grow. We have the peak number of people, the highest I think since in 70 years. Number of people living at home with their parents. Those people want to move out. Some of them are going to rent apartments, and then as the apartment market gets very expensive, because apartment rentals are going to keep going up, they're going to end up buying homes, because they're going to decide, hey, I'd rather just pay my mortgage than pay rent. Then we have if you're focusing on, like me, Florida, Texas, Arizona, you're going to see that the tsunami of people coming to this market from the retirement age, because there's next 15 years, we're going to have the baby boomers retiring. They're going to be coming down to these states with no income tax. So that's going to add to the growth of the markets. So you just put all those factors in your favor, you're going to do well. Let's see if this works. So YT, what do you want to ask? Faye, you're welcome. Thanks, guys, for all the love. Thanks, you guys, for liking my videos on YouTube and IG. Thank you guys for subscribing and telling your friends to follow the YouTube channel and the IG channel. I really appreciate that. It's a great way to... What? Yes, you want me to do it right now? Okay, I'll do it now. So, guys, what I'm going to be doing is I'm going to be giving away 2 signed copies of Rich Dad Poor Dad. Okay? I got a lot of great conversations with Robert Kiyosaki's when I was at the Belize trip. And so I'm going to be giving away these 2 signed copies. And how you get these copies? You subscribe on YouTube. So you follow on YouTube. And you get your friends to follow me on YouTube as well. what we're going to do is every time you get a friend to subscribe on YouTube, and I'm going to create a special video regarding these books. And what you do is you go there and you leave a comment of your username. Obviously, I'll see that by the comment, and your friend's username that you referred. And every time you have a friend subscribe to my YouTube channel, that's another chance for you to win. And why am I giving away 2 copies? 1 copy is for you, and 1 copy is for your friend. So if you go out there and you get 20 friends to subscribe, and I pick one of those 20 friends, you get a copy for referring them, and they get a copy as well. So this is a great chance for, you don't have to be worried, hey, is my friend going to get a signed copy and I don't get one? No. You both get a copy, signed copy of Rich Dad, Poor Dad by Robert Kiyosaki. So that's awesome. It's this is honestly, It's a life changer. It definitely opens up your mind. Like, I've been studying since I was 14 to invest in real estate. I read this book at 19, and it really helped plug a lot of things together and simplify the process, and just simplify it. Like, keep it really simple, dumb it down. Not to overthink on how it works. So by having a signed copy of Rich Dad Poor Dad, you automatically will become a millionaire next year. So no, that's not true. But it's gonna help you. It's gonna feel good, right? Like, it's gonna feel it's motivating. It gives you confidence, and confidence is big in this game, guys. I was telling today at lunch, even though I've done lots of deals and I have millions of dollars in real estate, I still get nervous. And am I making the right move? Am I making the right decision? Because I'm really, really hard on myself on performing well and buying amazing properties and making a significant amount of money on each property. So thank God, knock on wood, I've never lost money, which is crazy to say in the real estate game. But, I'm very thankful for that. And by being hard on myself, I'm able to make great deals. But again, by being confident in myself, I'm able to actually pull the trigger. And that's everyone's biggest issue. They don't pull the trigger. So get the right knowledge in your head, get the right mentors, and make it happen. Awesome. So let's see who wants to go live. All right, let's see if we can answer some more questions. God bless you, Faye. Thank you. Let me know if you see anything on the...
Okay.
So, Sean, what do you want to ask me?
Hey, what's going on, Baskal? So I wanted to know, is there any way I can get started in real estate, getting a rental property with about $2,000 to $3,000?
So you can. The thing is, the less money you have, the harder it gets. But the answer is yes, you can. Now, there's different programs. So I have a city by me. It's called Tarpon Springs. In Tarpon Springs, they have a home buyer program, and they give you, I think, $15,000 towards your down payment. And they'll actually give you that money towards the closing cost. So that's part of the down payment. You throw in your $3,000, and that will get you a property. Probably, it can even get you a property at $300,000 with a 3.5% down loan. So the thing with that is, if someone's coming to buy a $300,000 property in a decent area, you got some people offering 25%, 30% down. So you got a lot of people you're competing with today. So you might end up being not desirable area for that same amount of money. Now at that point, I'll probably try to get a duplex, triplex, or quadplex. So at least you're getting the most for your money in that area. But you got to make sure that you're really strong as a landlord, because what happens is if you're just too soft, they can walk all over you, and then, you might not collect your rent. So, and then, that's obviously not a fun situation. So being a good landlord is like being a strong parent, being nice, but understanding, hey, these are the rules. You gotta live by these rules, or there's consequences to these rules. So, but yeah, it's doable, but you gotta be more persistent. Don't be like don't let it get you down when you don't get the deal right away.
Okay. So you know what? What I mean to ask is, what can I do with $2,000 to $3,000? I actually, in sidebar, I have knowledge in digital marketing, and I'm starting a store, a women's athletic wear online. And I'm going to run the Facebook and Instagram ads myself. I'm pretty confident I can do that. But with this extra $2,000 to $3,000, I don't want to go back to a 9 to 5. So I'm finding out what's the best way to maximize this.
So what I'm gonna tell you is this: is that if you're doing 2, 3, 4, 5 things, none of them are gonna do well.
Okay.
Let me just tell you that.
Okay.
So when I started getting back into the real estate game a few years ago, I gave my insurance agency and my accounting firm to my wife. I said, you're going to manage all the staff. You're going to handle that. You're going to manage anything with the clients, conversations, whatever. Unless it's a very important conversation, don't get me involved. Unless it's a strategy session where like there's certain things that only I can set up a strategy and tell you how the company is going to be made, how the taxes are going to handle, how the insurance, blah, 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 and the mortgage is going to be done. I do that strategy session. Otherwise, don't get me involved. I'm focusing on this real estate game so I can get all those deals when they come up and I grab them right away. So, the thing with that is, so if you're trying to do well, you have to focus, is what I'm trying to tell you. So it's better if you're going to say, hey, I'm going to do this women's athletic line, plug all your energy, all your focus, all your time in it and blow it up. Because if you're trying to make real money, you're going to really have to focus. Because otherwise, I'm telling you, if you put 3.5% down and buy a fourplex in a lower income area and have a whole bunch of headache that could come with it, that will come with it, it's just part of the game, right? There's good stuff and there's bad stuff that comes with it, right? If you do that and you're doing pretty well in your women's athletic line online, then what's going to end up happening is that little money is going to take away from this thing. And both are not going to perform very well. So once you grow that big enough and it's large enough and it's scaled enough that you have the income coming in, it could either be one or two things. One, you make a great amount of money and you're able to get a manager that can do what you can do and you can go and do the other thing and build that other thing up. Or you can't leave it because you're making really good money, but you need to focus to keep making that big money. And then you just give it to someone else and that other person invests it in real estate. I got a lot of people that make a good amount of money and made money in either the tech world or made money in real estate. And they said, you know what? You're performing really well. You understand your market really well. And then they just give me their money. They say, look, I'm going to invest with you. You go do your thing. And I get a cut of the profits. So you could be either guy, but but right now the stage of what you're explaining to me sounds like you need to focus on that thing and grow it big enough. Because if you're like the only person on the team, then you need to grow it big enough until you have like 3-4 people on your team.
Right. Yeah. Because right now it's just me and my assistant. She's in the Philippines.
Yeah. So you really need to just keep growing your thing, getting it bigger. And getting it to the point where you got 4 or 5 people working this thing and it's making money and you don't really have to focus on it too much. And, you're only working 4 hours a week and making over $100,000 a year. Then you're at a spot where you can go and focus on opening another business. Until that time, you're just spreading yourself too thin.
Okay. This is my 3rd time talking to you. And every time when I say I appreciate it, like I appreciate your time, I appreciate you doing this every time. I got an alarm. My calendar goes off every Wednesday. Every time you're on live, I got an alarm set.
Awesome.
Man, I appreciate you, bro.
I appreciate you too. Thank you very much, man. And I look forward to you being successful.
Man, I appreciate it. I really needed that. More than you know. So I appreciate it. Take it easy, bro.
You too. Master says real estate is not a game. You will fail in less than 10 years if you don't know your numbers. That's true. There's usually a down cycle every 7 to 10 years, and that's really true. That happens. But the thing is, you also got to know that real estate is a long-term game. So you do have to plan on 10-year cycles of your deals, right? Yeah, I'm going to keep this property for at least 7 to 10 years. And if you're thinking you're going to make short-term money on this game, you're going to fail like, what's that guy?
Ramsey?
Ramsey. You're going to fail like David Ramsey because you can't look at it. This is a long-term game. I've heard this right now. There's people telling me, there's other guys that are in a real estate game and they're getting out of the game. They're selling most of their stuff, blah, blah, blah. Okay. Well, they're not really real estate investors. Real estate investors normally invest in real estate. They don't really get out, right? Everyone that I know, what they'll do, they'll shift into a different style of real estate, but they're still in the real estate game. All right. Let's see. I have Alex. Alex, what do you want to know? Is there any questions on YouTube or something? Okay. Hey, what's up, Alex?
Hey, what's going on? How's it going?
It's going good. How are you?
Pretty good. Glad to chat with you and maybe ask some questions. I guess I just joined your live here a few minutes ago, so want to maybe get some perspectives from you. I live in Southern California in North County, San Diego, and I have a property that I currently live in as homeowner occupied. I have a good amount of equity because just property values have been increasing, but there's been a couple laws that passed a few years ago that has to do with accessory dwelling units. And so just want to kind of get your thoughts on that. My thought is to, put it, refinance, build another accessory dwelling unit that would be, a 3-bedroom, 2-bath, 1,200 square foot single family home. And so it's a pretty big lot, and just want to get your thoughts on that, and what are some of the things that I should potentially watch for. I have a sales job. I do pretty well, so it's really something that's not a lot of risk. Essentially, on paper, as far as taking out a larger mortgage, but just want to get your thoughts there.
How big is your house right now?
So the current house I have is about 1,250 square foot. It's only a 2-bedroom, 1-bath, and that's the house that I'm living in currently right now.
So there needs to be more research done to accurately answer your question on is your ADU can be a 3-2, because it's supposed to be.
It can.
Now, because normally, from what I understand, is there's a size difference. Like your ADU can't always be bigger than your main house.
Right.
Unless you name your main house the ADU, and the larger house is going to be the new main unit. But again, you'll have to look into the details of that.
Based on that has to do with depending on the lot size. The size of the lot that I have is half acre. Mm-hmm. So I've already gone to the county. I've already done my research as far as what I can and can't build. So I already know that. Now it's just really about pulling the trigger. Construction costs have gone up quite a bit in the last year and a half, and so really I'm in a position where I can wait because I refinanced my mortgage within the last 6 months. So I have a smoking under 3% interest rate. I bought this property in 2015, so
what did
I'm
you
just
buy
kind
it
of
for,
seeing.
And what do you own it? What did you buy it for? What do you own it, and what is it worth today?
I bought it for $415, put 5% down. Right now, I think I owe about $365.
And what is it worth?
It's probably worth anywhere from $620 to $650.
That's awesome. So yeah,
Yeah.
It sounds like you should take them either way. No matter what you do, it sounds like you should take as much equity out as possible, because if the market does tank in 3 years and the equity disappears, you won't care because you pulled out as much money as possible. And unlike stock market investing, there is not a margin call if you owe more on your house than what it's worth. So you can use that money and invest otherwise in other things, other than even if you don't do an ADU. Part two, you said you have a half an acre lot, which is very large for California. If somehow you're able to split the lot in half and have 2 separate lots, then it's possible that you could probably build 4 units, because you'd build one house, then you'd build another house, and then you'd build an ADU on each one of those lots in the back. So now you have 4 units to build. The question
I looked at that in the county, and it's quite a bit of money. When I talked to the county, because this was something that I was already having in mind as like something for my parents to live in as they retire. But for me, with the new ADU laws and the way they cut a lot of the fees, it just seems like a really good opportunity in this area where everything they're building now in North County, San Diego is most like townhomes, if you know what that means. They're not really building single family housing, so I see that there could be an opportunity for lots that are 10,000, 20,000 square feet to build more single family homes that the rents are so high. Like just in the city I live in, which is population 60,000 people, there's probably 4 to 5, maybe 7 houses, single family houses for rent, which is extremely low, at least what I'm seeing on the weekly basis. So I think there's an opportunity, and those rents do command pretty high.
And it's similar with us. Our lot sizes are smaller than yours. We don't have, because a half an acre is 21,000 square feet. Like our lots in the suburban market can be that big, but if you're closer to a downtown market, if you have a 7,500 square foot lot, that's decent size. And my style, what I do is my brand is Coastal Cottages. I actually target those single level homes that are little cottages all on the same lot, that I rent them out,
Mhm.
because it's not 2 stories. Older people like that, and there's not many available, where they basically have their own little cottage, their own little home. So it's a good idea. You have to run your numbers. You have to see. There's 2 factors this is what normally happens when you're in LA and you're in New York, you're in good parts of Chicago or Canada, is that when you're building, you're going to build, and you're probably going to be building, if you're lucky and you got the right connections, you're going to build under what it costs for a sale. But what the part that's missing is that the rent doesn't always cover the cost of the return for your cost that you spent, right? So if you build a 3-2 and you build it at, say, 1,800 square feet or 2,000 square feet, and it costs you $500,000, are you going to bring in $5,000 a month to justify that?
Right.
So, because for example, like I always do it this way. I said, look how much you're going to make if you did it on your own, ran it on your own, run your own numbers, and then look at how much my investors get for doing nothing. And if you can't beat that number, that means it's probably not a good deal to do. Because if my investors do nothing and they make this much, that means you should be able to make double that if you're going to be doing all this work. So just think of it like that, right? If I'm doing all this work, I need to get compensated for it. Otherwise, if you're getting paid well in a sales job, you're going to make way more money just doing your job more of your job, and not even focusing on that other thing.
Right. But I mean, see, the goal is to get kind of where you're at, right? Be able to buy, have enough doors here. And I want to invest here in North County, San Diego, where I live. I love the area. I know the area and the market very, very well. So, the goal is to take my income, right, live below my means. I already have this property that I have a ton of equity in. And just, eventually by the time in 10 years, be able to choose, do I want to do W-2 work, continue to do sales, or do I want to continue to even more press hard in, other, business ventures, passions, whatever you want to call it. So I don't want to, have a W-2 job forever. The goal is to take the money I'm making now, I'm in my mid-30s, and try to, make that push in the next 10 years to eventually have enough, good properties and good locations, right, where I know the locations here in this whole area, and have good properties that want to hold on, right, and collect rents, because rents have, since I bought my first property here in 2012, I mean, that's where the real estate nugget kind of came in, because I bought it obviously in the market that was very prime, and then 3-4 years later I made the most money I made. So that's really where the light bulb went on. And so I'm trying to repeat that, but do more buy, hold. So, just trying to figure out what to do with this, home that's in a good location. It's really the little brother next to the big brother houses. I got a 5-bedroom next to me, another, 4 or 5 bedroom to the other side. So it's definitely a good property that. What's that?
What is a 4-bedroom rent for?
You're probably looking around 4,000.
So how much would a 3-bedroom? How much would a 3-bedroom rent for?
3 bedrooms. If it's in bad condition, probably about 28. In decent condition, about 31 to 32. In great condition, like turnkey, just remodeled, probably around 34 to 36.
Okay, so me and you are saying the same thing. I would also like you in 10 years to have the luxury of quitting your job because you have enough passive income from a source. Okay? What I'm saying is to do it in your market, and I know many people that are very smart in your market that left to say it's hard to make money. I'm not saying you can't do it. I'm saying to do the return you're going to get on your investment for doing it in your market in 10 years compared to you doing it in a different market that is going to help you more is going to be better elsewhere than where you're at. So in 10 years, if you're doing what you're saying, let's play with the numbers. Right now, you do a cash out refi on your house. You owe like what? You said 380?
365.
365. And it's worth 680?
640.
Okay, so if you're at like 70% LTV, 70% LTV, let's say 75% LTV, you're looking at $450,000. So you now have an extra $100,000. Okay, what are you going to do with that $100,000? You're going to build that building in the back. The building in the back is probably going to cost you $400,000, $500,000. So you're going to need money to build the building in the back. It might not be that easy for you to get that construction loan, right? I don't know how easy it is to get an ADU construction loan in your market. Now, but let's just say you spent that $100,000 and someone suggested buying a condo. It is horrible return to buy a condo. I've never seen anyone make more than 3% on their money investing in a condo, ever. The only scenario that I've seen that to be wrong or to that 1% chance is when someone bought a condo in 08. I bought a condo for $29,000 in 08 in a good area. Okay, that's that 1%. Minus that 1%. When you count the purchase price, the taxes, the fees, the association, you're lucky if you make 3% on your money. So, or 3% on your equity money, so on. So when the pen hits the paper, and you pencil out and you pen out your plan. Why I already have the answers. I've ran numbers since I was 14. I'm 21. I have an accounting firm. I have a mortgage company. I have a real estate investment company. I have a property management company. I have a construction side. I ran all the numbers religiously. I'm a numbers person. The numbers to actually accomplish what you're saying in your market is very, very difficult. Now you can buy some parts of the country. You can get a fourplex for $400,000. Not really the type of area I would want to invest in, but there are some good parts of the country you can get a duplex for $400,000. 25% down, rent that out, your ROI is going to be higher. Like I said, my investors are going to probably make 5 to 6 times what you would make on your property. So you do nothing, you would make 6 times the return being with me than doing it on your own, which means you shouldn't do it.
Got it.
So unless I'm going to do it and I'm going to sell the property immediately.
See, that's the other thing, right? Since my house is a 2-1, right, it's valued at that. But if it was a 3-2, now the property values in my neighborhood are probably 700 to 800. And so so it's like, okay, if I add another bedroom, remodel the inside, bring it up to date, now you're talking, that 3-bedroom, 2-bath is probably, 725 to 785.
So then the question is, it's worth, so what you said is you're going to spend some money and you're going to bring the property value up roughly $85,000. The question then comes, is it going to cost you $85,000 to increase the property value $85,000? If the answer is yes, then you just did a whole bunch of work and made nothing
for no reason.
For no reason.
Correct.
That's what I'm trying to say.
Right.
If you put the number on paper and you say, okay, if I put my money in that, what I want you to do is benchmark what my people do, spending no money and spending no time, right? If Baskal's investors make this much and spend 0 time, I need to benchmark that against what I'm doing. I need to make more than that. And I need to add in my time, what I'm going to do working. So whatever this is, plus the time I'm making working, I need to make this much minimum to break even on my decision. And anything above that, then I'm making money on my decision. So if it's fun, like I have some investors say, I really want to buy this property. I said, look, you want to buy it? There's an intangible value for your joy. You want to do it for fun because you think it's going to be cool and fun and you want to do it? Do it. I bought this house here. I felt paid market rate for it. I don't like paying market rate for anything. But I did it because it's right by where my mom is. My kids are going to be happy. My wife's going to be happy. Everyone's going to be happy. So I said, you know what? I'm going to spend the money even though I didn't get a steal. I just paid market. Mm-hmm. So there's a value you pay for happiness, for joy, for fun, right? People buy classic cars, spend a ton of money building them, and then sell them for half the money that they spent to build it. But you had fun. So just understand what you're doing, and as long as you know what you're doing and you accept your understanding, then okay, do what you want to do. But if you want to be financially free in 10 years and that's your goal, you're fighting an uphill battle, and that's what I'm trying to show you.
Right.
And Mastro wants to know, he keeps blowing it up. Mastro wants to know, what is your why? What is your why? Why do you want to be financially free in 10 years?
Well, I have two young boys, based 5 and 7. And so one of the ideas was thinking, okay, this house here, right? I have to put in some work, right? It's old, it needs some work. Obviously it's a 2-bedroom. So for now it works because of little kids, but I'd like to have a 3-bedroom. So my idea was, if I build an ADU, right? I basically have 2 single family homes on this, 20,000 square foot property. If I essentially I'd be doing house hacking, my portion of the mortgage would be a little bit less than what I'm paying, but I'd have a brand new 3-bedroom, 2-bath, fully renovated, right? Plus another person paying me top, rental, rent, which is right next to a marine base, right? So I know that the rental market here is always going to be good, right? So it just kind of made sense to have a brand new remodeled, house for me and my kids. And then be paying, a little bit less than what I'm paying today, even though I just refinanced. So to me, it's like, in that case, if I'm house hacking, it made sense. And then one day, it'd be something I'd hold on to. One day, I have 2 sons, there'd be 2 single family homes there. So that's been my why. And as far as the real estate investing, I figured, well, still invest my money. I like real estate, and continue to do that, buy homes. But the way you're talking about it, the low market, do the work, right? Buy properties at a below market, whether it's now in 2 years, 3 years.
It's not always below market. Don't get me wrong. Like, what I'm trying to say is, I like your idea, but the thing is, if you're going to spend $400,000 or $500,000, and then you put that into a cost of a mortgage, and then you add in the taxes and the insurance, the amount of money you're going to collect in rent is basically the same amount of money it's going to cost you to have the property. You broke even. Mm-hmm. And then if you're saying, well, now the property value increased $500,000, but it cost you $500,000, you then broke even in equity.
So let me ask you this.
If your goal was, right, because I know a lot of foreigners like myself will be like, I want my kids to live right next door to me, and you had a house, and then you had this one house, and then you built another house, and now your 2 sons live next door to you, and that's your goal. But like, okay, you accomplished your goal. all your family's right next to you. But you did it because you wanted that and it felt good, not because of a return on your investment. Because you could build many other things to earn higher return. In between now your son is 7 to the time he's going to move out and move next door to you, 27 years old, 20 years from now, you can invest your money way other ways, right? And invest $100,000, bring it back, and then in 20 years it's worth $2 million. Investing it in other ways, and then just spend that money to buy whatever you want to buy, a whole bunch of houses right next to each other.
Right. I see what you're saying. So it's really coming down to numbers. Now let me ask you this one question, because to me, obviously, appreciation is, that's not really something that's, I guess, tangible. Yes, in today's market, but of course things always change. Let's say, run the numbers. It's something where you did put in $500,000 to, put in another single family home, and then now the property is worth 1.3, 1.4. Would that change? Of course. Your thoughts on it? So, for example, the triplex that I bought on Beach Drive, it's under contract now. $925 is what I paid for that waterfront house. Triplex, no flood insurance because it's high up. That one I'm putting in $500,000 into it, so I'm in for like 1.425. It's right now 3,000 plus square feet on Beach Drive, fully remodeled, is $3 million. So my down payment for the purchase plus remodel is probably like $450,000. So in 1 year, I have $450 plus another $1.5 million in equity. So I just quadrupled in 1 year. And then I'm going to rent it out. I'm going to do a home equity line. I'm going to do a refi, pull all my equity back out, rent the property out on Airbnb, half rent, annual rentals, and we're going to pull probably 30%, 35% annual return on that property. Right? We're not talking about 4%, 5%. We're talking about 35%. Now, after all the fees and costs and whatever, my investors normally make like 20%. I don't advertise that, right? But some of the great locations that I get really lucky with getting pull those numbers. You need to find something like that. Not a property that is today worth $2 million and you bought it for $1 million. I'm saying you need to find property today that's worth $1 million and you pay $1 million, but if you put in another $500,000 into the property, it's now worth $2 million. And as long as I have a 33% increase on the value, basically I'm burring apartment complexes. That's what I'm doing. I'm doing the burr method on apartment complexes. Got it.
At that point, you have enough equity, you could refi, have no cash in the deal, and then you could do some Airbnbs as well to increase your cash flow even more, have a more aggressive return on your money. So that's my strategy. I simplified it. There's 1,000 factors that go into this, but I made it really simple of what does it take to win and what do I do it and why do I do it? Is because I can burr the property and then make a ton of cash flow after. And normally they're diamond properties. I call them diamond properties because they're properties in downtown cities that people want really bad and they're always going to want them. I don't really look for just standard duplexes in a neighborhood or standard homes in a neighborhood that there's 1,000 of them. Because if the market goes bad, some of those people, 10% of those people are going to lose their home. Those 10% now hit the market. That's a lot of homes to hit the market, which is going to cause a drop or a flat line. And if the properties don't drop in value, what it'll do is it'll flatten the increase in property value. Instead, I buy unique properties that are rare. So when they come up for sale, there's not many other ones like it. So people want it and there's still a demand on it. In your situation, say you build an ADU, you have a 3-2 and a 2-1, and it might be unique and you might want to sell it. Someone's calculation might come to the point of, well, if I'm going to have to pay $1.3 million for this house and the market's down, why don't I just go buy a 3-2 and a 2-1, one for $700 and one for $600, and now I'm at $1.3 million as well. So you're not in such a unique scenario where it would have such a huge driving factor to still pay a premium for your property.
Got it.
So just what's that wow factor as well? I always have a wow factor. I always put on brick paved roads. I really try to get a property on brick paved road. I always try to be 1 block from the water. I always try to be right by a downtown market where people can drive a golf cart. A lot of the communities I buy in, you can golf cart to the downtown and not even use a car. You can drive a golf cart on the road. So a lot of stuff of the wow factors.
Awesome. Well, I appreciate that insight and just kind of looking at it and talking it through. Definitely makes sense what you're saying. It's like, well, if you're going to put 100 grand and you're only going to have maybe 120, well, then that's not a big delta of return for you to put in the time, the energy, and so on and so forth. So, but yeah, appreciate your time.
Awesome. DM me if you have any more questions.
Absolutely.
I'll see you.
Thank you.
All right, guys. Well, it's now 10:39, and it's pretty late here. I got to get up early. God bless you guys. I really wish you the best. If you need to know what you don't know, take my course, Foundations of Personal Finance. It's a link in the bio. Remember, follow on YouTube. Suggest to your friends to follow on YouTube. Suggest your friends to follow me on IG. We're going to do the giveaway. The more people that you ask to or tell to follow my account, there's more opportunities for you to win. Signed copy of Rich Dad Poor Dad by Robert Kiyosaki. I appreciate you guys. Love you guys. Have a great night.